good things.
So Joel, you mentioned buying things for a lot less than they're worth, and that provides the margin of safety.
Yeah.
Would you say that those are the core elements in value investing? And do you want to enhance that definition, or is that enough?
Well,
and one other question.
Sure.
You mentioned that you didn't think it would be a great idea for your in-laws to try to find the next Picasso. Would you analogize that to growth investing?
Sometimes. I mean, my definition of value investing is figure out what it's worth, pay a lot less. It has nothing to do with low price book or low price sales. And so that's how a lot of people like Russell or Morningstar would classify value investors. And so they probably wouldn't classify me as a value investor or a growth investor. They kind of don't know what to do with us. And, as Buffett has said, growth and value are tied at the hip. I mean, part of what makes value is investing in a business that can grow over time. So they're not two different way they're classified by, let's say, Morningstar or Russell. Maybe there's much lower growth in value and much higher growth in growth, and they make it that way. But I'm looking for good businesses that are cheap. Ben Graham said, figure out what it's worth, pay a lot less, leave a large margin of safety. Between those two, big space between those two things. Warren Buffett, his best student, made one little twist that made him one of the richest people in the world. Buffett simply said, if I can buy a good business cheap, even better. Part of good is a business that can grow over time. And so I slowly gravitated, not fast enough, certainly in my first decade of investing, gravitated more towards the way that Warren Buffett invests. He's looking for good and cheap businesses, and growth is part of sometimes being good.
But at the beginning, Buffett wasn't so entranced with good businesses. He was famous for starting off with the cigar butt approach, where he wasn't looking for quality, he was just looking for cheapness. But then he too made a transition.
Yeah, I mean, my master's thesis at Wharton, or it turned into that, with my friend Rich Pazina and Bruce Newberg, was a paper we wrote that eventually got published in the Journal of Portfolio Management about buying cigar butts. They were called net nets, buying stocks selling below their liquidation value, and showed that just buying, if you bought it cheap enough, you could make nice money. And that's sort of the way Warren Buffett started. But when you think about why we move towards quality, let's say you find a stock that's worth $10 and it's selling at $6. It's pretty cheap. But if you're not controlling the business, and it's not in a good business, your margin of safety may erode over time, meaning that $10 could turn to $8 if you're not really controlling those assets. And what you're really looking for are businesses, or what looks better to me anyway, are businesses where that $10 might be growing to 11 or 12, increasing your margin of safety. So I might take a lower margin of safety if I thought that was growing, but there's more. Buying things cheap works. I mean, cheap alone works. I have nothing against it. It's just that you have to get out of it. So Buffett, who runs $100 billion or some number like that, it's not easy to go spend $5 billion and then go sell it to some other guy who's going to pay you more than the $5 billion. It's too big. So when he was, and he said as recently as, around year 2000, he said, well, if you give me $1 million, I can make 50% a year on that. There's plenty of opportunities. Your opportunity set shrinks as the businesses become larger. If you can invest in anything, if you don't have a lot of money, you can invest in thousands and thousands of businesses. Buffett is now looking at the top 300 businesses in size, because the smaller ones they won't move the needle. So there's a lot you can do in special situations. One thing a lot of my students ask me, and it happens every year now, probably for the last 5 or 6 years. And the question they ask me at some point in the semester is that, when you were younger, because you're really old, they leave that part out, but you're really old, and when you were younger, things were easier.
That goes unsaid.
Yes. Well, I just said it. But anyway, things were easier. There was less competition. There were less hedge funds. There were less computers. There were less smart guys going into this business. I mean, when I got into it, I was telling Howard before, market hadn't gone up in 13 years by the time I got to Wall Street, so it wasn't a place that really was attracting lots of people. So they said, it used to be easier for you, but, it must be harder for you. Hey, you stupidly wrote a book about this, and there's a lot of people doing this now, not just because of that, obviously. It's harder for us. You got the easy stuff. And so my response is this. People who are very good, especially in a special situation, I have two responses. One is people who are good at special situation investing, really looking off the beaten path for liquidations or recapitalizations or spin-offs or any of those things. Many of them are liquidity constrained. Warren Buffett started making a lot of money doing those things, but he grew too big. And so I tell them that, listen, what happens to people who get very good at analyzing businesses in this area? What happens to them is they make a lot of money. And they get too big to stay in this area, so there's always a new group of people who can come in and look at some of those smaller situations, because the guys who are really good at it get too big to really take advantage of some of the smaller or more obscure situations. And so there's always room for new people to come in that area. And then on a larger scale, because people still teach efficient markets, and they'll say, hey, active investing doesn't work, and even Warren Buffett's saying go buy some ETFs or indexes and everything else. And what I'll say is that for most people that's true because they don't know how to value businesses. But I will give you a counter, and this is what I tell my students. And most of my students are around 27-ish or something like that. So I tell them all, let's go back to when you were roughly 10 years old, where you might start noticing some of this thing. And let's go look at the most followed market in the world, and that would be the United States. And let's go look at the most followed stocks in the most followed world, in the most followed market in the world, and that would be the S&P 500 stocks to a large extent. And let's take a look at what happened since you were 10 years old. Take a look at the S&P 500. From 1996 to 2000, it doubled. From 2000 to 2002, it halved. From 2002 to 2007, it doubled. From 2007 to 2009, it halved. From 2009 till today, it's basically tripled. That's my way of saying people are still crazy. And that's really unfair thing to say, because this S&P 500 is an average of 500 stocks. There's huge dispersion going on within that average between stocks that are in favor, that people love emotionally, and stocks that people hate. So it's really much worse than what I just described. There's huge dichotomy between things people like and people don't, things that are in favor, out of favor. Within that is all this noise is going on within that average. That average is smoothing things. So if you believe what Ben Graham said is, here's fair value, and here's what the market prices are. It's like a wave around fair value. And if you have a disciplined way to value companies and buy more than your fair share when they're down here, and sell some maybe if you're shorting, and you're very disciplined. I make two guarantees to my students first day of class. First guarantee is this. If they do good valuation work, I guarantee them the market will agree with them. I just don't tell them when. Could be a couple weeks, could be 2 or 3 years. But I tell them the market will agree with them. And the corollary to that is this, and it's very powerful. I tell them in 90% of the cases for an individual stock, 2 or 3 years is enough time for the market to recognize the value they see if they've done good work. When you put together a group of companies, that actually on average is actually happening quite a bit faster. So, both those are very powerful. It just says good work will be rewarded. So I don't think the reason people don't beat the market is because the market is efficient or even close to efficient or not emotional. It's very emotional, or that it can't be done. There's all kinds of institutional and agency reasons and tons of other reasons why they don't do it. But because prices are efficient, if you just pick up the paper or observe what's going on or listen to what I told my students since, when they were 10 years old, it's pretty clear that people are still crazy and there's opportunity out there.